Hi, this is Stacey Hyde, and I'm back with another episode of Better Financial Health in 15 minutes or less. And today I want to talk about something that we've gotten a couple of questions on, and I think it's a good thing to look at for savings when you're going to need the money in a couple of years and you can't afford to risk losing anything, but you're looking for something that's going to earn you more than the 0.01% that you can earn in the bank. And what I'm talking about is a form of government savings bonds called Series I bonds. And the I stands for inflation. So you can find out more information about these at treasurydirect.gov, G-O-V. And the neat things about these right now is the interest rate right now is 7.12%. Wow, that's great. So Series I bonds pay a stated rate of interest, which is actually 0, plus an inflation adjustment. So that's 7.12. The rate is reset every 6 months. So sometime in April, we'll find out what it's going to be for the next 6 months. And these have a 30-year maturity date. But don't let that scare you away. You are required to hold them for 1 year. So if you're going to need the money in 6 months, not a good place to park this money. So, but if you're going to need it in 1 to 5 to 10 years, could be a very good place to put it. And you can choose to either pay tax on the interest each year as it's credited to your account. I will tell you, almost no one does that. Or you can choose to pay it at the end when you cash it out. And if you use the proceeds of the I bond for certain education expenses, you may avoid paying tax on that interest at all. Depends on your tax bracket. So the key thing is, if you hold the bond less than 5 years and you cash it in, you will give up 3 months worth of interest. So an example, say you held it for 18 months. You would only get interest on 15 months, not the full 18, because you're going to give up that 3 months interest. But if you're earning, say the interest rate drops when they reset in April to 6%, so you're getting 7.12 for a couple of months, 6%, and then maybe 4% after that. Even giving up that 3 months interest, that's a much better rate than what you'd get in a savings account. What's the catch? The catch is you have to go to treasurydirect.com .gov and open your account. It is not the most user-friendly thing, as I'm editorializing now, but it's my podcast, as are most things that are run by the government. It's a little bit cumbersome. For example, when you go to type in your password, don't lose your password. You actually have to type it out on a keyboard that shows up on your computer screen. So don't try to do this on your phone. It may make you crazy. You definitely want to use an iPad or a computer. You have to click it on the keyboard. They do that to prevent fraud, which is a good thing. You can purchase a total of $10,000 per person. So if you're married, each spouse can have an account and do $10,000. The way to get an additional amount purchased is if you are due a tax refund, you can apply up to $5,000 of your tax refund to purchase Series I bonds as well. So that's the most you can purchase. You can also purchase them for other people. I actually met with a couple today, and they had opened some accounts at the local bank for their grandkids. And I actually recommended that they switch that to Series I bonds, because their goal for that is not college. They want to be able to buy them a car when they go off to college. So I think that was a great kind of option for them to use, as well as for themselves. So to recap, Series I bonds you have to purchase on treasurydirect.gov. You can purchase them in any amounts. I believe the minimum is $25 up to $10,000 in any amount. And that is the most you can purchase in any year. So for example, if you purchase some now, you could turn around in January and buy another $10,000. So you can sort of layer them like that. You'll use the same Treasury direct.gov account login to look at them, see what you have. And I think they are a great way to save for shorter term goals that you may not want to just get what you can get in a bank, but you also want the security that you will certainly get your money back. Can be a great option. So thanks for tuning in. This has been another episode of Better Financial Health in 15 minutes or less.